Okay, Mr. Sheye. Can you hear me, Mr. Sheye?
Yes, I can, loud and clear.
Okay, we start in 5 minutes.
Great. All right.
Yeah. Welcome, everyone. Welcome. We're giving people more room to join. So we're starting 11:05 on the dot. We're giving people more room to join. If you are just joining in, welcome. We would start 11:05, exactly 11:05. We're just giving people more room to join in.
Hi, everyone. How are we doing? Good morning. It's an absolute pleasure to have everyone join this exclusive webinar. I think we'll be talking on one of the most important things to most entrepreneurs in Nigeria, in Africa, in the world, right? And I think that we've really got the best people in the room to speak towards this. So without further ado, I think we are going to kick off. My name is 𝐂𝐚𝐥𝐿𝐴 I'm the head of strategic partnerships and innovation at Bundle, right, which is a customer engagement and loyalty platform that's built for an economy such as this, right, where customers, want an added exchange of value for the things that they do with their favorite brands. But more than that, I've had, more than a decade of experience supporting SMEs, supporting startups across different ecosystems, Africa, Europe, and in the US as well. So I'll be your host for today. And I think, I have some other people in the room that will be introduced in a little while who are way more qualified than myself to speak towards some of these, really, really important issues for many of us in this room. So the theme for today is funding and finance. Smart ways to secure capital for your SME, right? The lifeblood of every business, right, is cash, right? So I think that this is something that everybody is going to be very, very interested in. I think we should also remember that some of the biggest companies today, right, in the world started from small dorm rooms, small kitchens, right, garages, right. Google started from the same, Microsoft, many others, and so for us in Nigeria, right, we have to realize that, even though many of us are starting with that pure hustle and maybe a prayer, right, this is really something that can scale, right, if it's done intelligibly and with the right tools and knowledge. And that's really what we are here to share and to talk about. And this is going to be a two-way conversation for this webinar. Okay. So just a little bit about 360 Consult. So 360 is a leading business consulting advisory firm. They've supported African enterprises, and helping them just to scale. So they're looking at how do we grow sustainability, combine smart strategy with strong compliance frameworks. And I think this is even more important now, right, in Nigeria than before, because compliance is something that not just larger companies but smaller companies are starting to grapple with and have to sort of be abreast of, right? So I think having companies like or advisories like 386KONSULT, right, in your corner, right, is exactly what you need, to build that resilient business for scaling across Africa. When we look at this webinar, right, I think it's also important for us to position it, right, to sort of understand why is this important, right? I think the first thing is that funding shouldn't be a mystery, right? It should be something where we can understand how money, how to play around with money, right? How to speak the language of money, right? How do we secure capital, right, as SMEs, right? How do we unlock it in practical ways, right? And we have, people from government, to venture capitalists and more, right, that are going to help us unlock that too. I think that this webinar is built for African SMEs, right? The funding landscape is different, right? If you're looking at Europe or in Silicon Valley, right? So we really need to be talking about here, right, in Nigeria. It has been a bit difficult, right, over the last, say, year and a half, especially if you're a startup, but also, I mean, for SMEs, right? So we don't want to speak just theory, right? We want real talk for real businesses, right, across Africa, whether it's Nigeria, Kenya, Ghana, Rwanda, Uganda, right? So basically just, talk for real businesses like yours, right? And third of all, learning from the pros. And when I say that we have amazing pros in the house today, I think, you have to hear them speak to believe me, right? They've walked the funding journey themselves, and they want you to avoid all of those costly mistakes, right, that they've made, right, and also missed opportunities as well. So I think that's really, really important. And then fourth of all, right, we all like, resources, right, and freebies. So every attendee today, right, will be walking away with an SME success playbook, right, that, touches on a lot of things that we're going to learn, but even more, right? And then you're also going to get a funding readiness checklist, right? Certificate, right, that just says that you've been part of this webinar as well. So just a little bit about the agenda. I know it was on the screen just a little bit ago, but just really quickly before we jump to today's talking points, which is what everybody's waiting for. So we're just going to have a little bit of an introduction, which I'm already giving, just to place set and help you understand what's coming. And then we have our first speaker, Adefola Juwon, right? And he'll really be speaking on how to find the right type of money for your own business, right? He's a seasoned professional, as I said, and we'll be learning a little more about him in a second. And then we'll have Sharifa Balogun, who will be speaking on what investors, right, want before they can give you money. And this is very, very important, because sometimes we have the right ingredients, we have an amazing idea, we have an amazing product, we've got product market fit, but not speaking in the way that really helps an investor to understand that this is the right place for him or her to put their money, right, can really lose the deal for you. So I think we'll be very, very interested in learning what she has to say. And then, of course, we'll have David Adeleke, right? And he'll be speaking on, are you ready for funding, right? Let's literally check this together, right? And sometimes, you might not, it's not a negative, right? Not being ready for funding, because maybe if you go too early, right, there's certain things that potentially you're not thinking about, but it's also good for you to know where the gaps are, so that you can ensure that you are actually ready for funding. And then, of course, as I said, it's going to be an interactive session as well. So we're going to leave time for all of your really, really interesting questions. We want to hear from you as well. Okay, so without further ado, I think we'll be pulling up our first speaker. And so please welcome Adefola Juwon. He is a startup mentor for SDC Startup School, right? So Juwon has been an experienced investor for over 6 years, right, across venture capital, private equity, and investment banking in Africa's startup and growth stage ecosystem. He's reviewed more than 1,000 deals, helped facilitate over 10 million in funding at Oak Capital. He played a key role in launching the Acorn 700 fund, leading due diligence, financial modeling, and deal structuring. He was previously at Razors Partners, where he supported founders in fintech, edtech, health tech, and more to secure capital and refine their strategies. So I think, without further ado, please let's welcome to the stage Adefola Juwon. Thank you very much.
Hey, hello everyone. Let me know if you can hear me. You can hear me, yeah? Can you hear me?
We can hear you.
Yes, we can.
Yeah. All right, it's good to be here. Thank you for the introduction, Olusha. Right, as Cher said, I'm an investment professional. Basically, what I'm just going to do today is, run through the landscape of funding, right? So I'm going to call across equity, debt, the likes. Also, give insights as to what each problem tends to occur in each of those types of funding sources. Also, at the end, we'll talk about resources and actionable steps, right? So I'm going to share my screen now. Give me a sec. This window. Okay, let me know if you can see my screen.
Yes, I can see it.
Yes, we can.
All right, great. All right, so we've already done my introduction, so I'm just going to dive straight into it. So a brief intro on SME in Africa, just a few stats, right? So, your small, medium-sized enterprises contribute to 80% of Africa's employment. So most of the GDP that Africa generates as a whole, right? SMEs power it. They also account for the large percentages of businesses in Africa, often over 90%. I don't know if anybody came across the Economist's article last year talking about how Africa has little large businesses and corporations, right? This is, evidence of that. Africa is mostly powered by SMEs, but we have a 300 billion plus financing gap. I mean, at least that's the reason why we're here, right? To try and bridge that gap, to identify sources that will make us actually get some of that funding to plug our own individual business needs. Now, so that's something I like to call the funding menu. Like, it's basically types of funding that you can use at any stage you are in your business or in different particular industries that will likely fit, that type of funding. So, for instance, traditional debt, right? So, what are examples of traditional debts? You have your microloans, that's from, microfinance banks or institutions like your LAPO, for instance, your commercial bank facilities, the ones you get from Access, Zenith, GTB, or your asset finance, right? Basically, you can get this from microfinance institutions, you can get this from banks, you can also get it from much more tailored, assets finance backers. So this is basically when you're trying to finance maybe a large capital expenditure. If you're in manufacturing, you want to buy new equipment for your manufacturing plants, that's something called asset finance. Then trade finance is basically commodity trading. So for example, a farmer in Ondo who wants to move cocoa to maybe Nestle in Shagamu, right, will probably need a line of credit to be able to finance the gathering of cocoa, not only just from his farm, but other farms to move that, right? So what's traditional debt? As simply put, is borrowing money and you repaying its interest, right? Most times when this is usually the case, and the best time to actually use traditional debt is when you have steady cash flow and you have collateral. For example, just 2 days ago, a lady who runs a logistic company for about 6 years, right, came to meet, some group of people, and I was in the conversation, and she was looking for financing, right? We had evaluated about 36 deals at that particular point in time, but she was the only one with the right finances and the right asset valuation, right, that would be used for collateral to make it easy to raise money for her, right? So most people always wonder, oh, why can't I actually get money from the bank or from a microfinance institution? I sent this, I sent that. Most times, everyone is looking at your cash flow. And if you're an SME, most times what they look at is the top line. So what's the top line? The top line is basically your revenue, your cost of goods sold, and the gross profit, right? So your gross profit margin, the larger it is, most times what they're looking for is at least between 20 to 30% gross profit margin. At least at that particular point, the larger it is, the more easier it is for them to actually analyze a repayment from your revenue, right? Next one we're looking at is grants and subsidies, right? This is where most people tend to pour most of their effort to. Understandably so, as I mentioned, traditional debt has its issues, right? So, and then again, nobody wants to give out time, cash that they can probably reinvest into something else, and also a part of their business. And grants tends to solve this, right? It's a non-repayable fund for specific goals like job creation or innovation, right? Most people who actually give grants give them to probably sustain the SDG goals, right? You want to improve job creation, reduce poverty, the likes. You have, for instance, the 𝐂𝐚𝐥𝐿𝐴 Foundation, who's more of like Afro-capitalism, trying to improve job creation. So examples, you have government programs, you have DFIs, you have NGOs, and donor grants, like, as I mentioned, 𝐂𝐚𝐥𝐿𝐴 Foundation. Another that we have is equity and quasi-equity, right? So equity is selling a part of the ownership of your business, right? So when you register your business, and not just a business name, because a lot of SMEs do just register a business name. But I mean a limited liability company where you have to have share capital. Share capital being the amount of shares that qualifies you as the owner of the company, just simply put, right? So initially, as the owner of your business, you probably have your 100%, right? But if you are raising money, you probably have to sell part of that 100% to an investor. That's basically what equity is. Quasi-equity is the mix between traditional debt and equity. So it could come like this. You could say you're raising, 100 million naira. 50 million naira could be equity, right? You're probably giving the investor 20% of your business for 50 million naira. The remaining 50 million naira will be in the form of debt that you probably pay over time, right? And examples of people who tend to actually do this kind of deals are your angel investors, venture capitalists, private equity, also people who are into revenue shares like your non-interest banks, and also crowdfunding platforms, like Kickstarter, Get Equity, and the likes. The next is hybrid and alternative structures. This basically just means the mix of everything else: your grants, your traditional debt, your equity and quasi-equity. And the reason why I included this year is for one particular reason. Back in 2022, there was a business we wanted to fund back at the old capital, but we felt they're too expensive for us. But they had a very interesting story, and this was right. So they were a telehealth company, telemedicine, right? Health tech, where you can actually speak with a doctor, over the internet. And what they did was they mapped out a 5-year plan, right? Where they structured how they're going to raise funding. The first was they're going to use debt to scale. It doesn't matter where they got it from, either from microfinance or from family and friends with an interest to pay. But then by their third year, they went full on into grants, right? So with the debt, they scaled their business to a point, but also they realized that there were some capital expenditures that they needed, and using debt to service that was going to put the business in jeopardy. So they went full on going into grants, got grants from the 𝐂𝐚𝐥𝐿𝐴 Foundation and some other people, used that to buy, some of their processing machines, which actually now further helped them scale. Then back in 2022, 2021, they went full on into equity. So this is an hybrid structure. You can structure in the stage of business what kind of funding would be most useful. Now, why is it so hard, right? Trying to raise funding in some of the sources. And I did a sort of timeline. I tend to group them into about 5. There are 5 issues that tend to come up. They're either structural issues, cultural issues, regulatory issues, informational issues, and I like to put something called additional issues. That's something that is outside of the 4 initial issues. So traditional debts. A very good statistic from World Bank is in Africa, only 20% of SMEs have lines of credit from banks, right? You're probably wondering why. A very big issue is collateral. Most businesses can't put up the collateral, right? And also, it's also from the bank side, right? Most banks tend to see far much more cash flow and far much more result in repayments with backing already large businesses with steady cash flow, right? And 20% is very low. We can't, as SMEs in Africa, 20% line of credit can't do anything. Compared to Latin America at 44%, and we still say, from a global perspective, that Latin America isn't growing as fast as intended, but at least they have a line of credit at 44% available to most of their SMEs. So we need to like jack that up. Another is cultural issues. So there's a trust gap, which I already mentioned from structural issues. There's a trust gap between banks and SMEs, right? Banks already perceive SMEs as high risk, right? It could be the failing of the government, it could be policy, any how you want to look at it. But typically, if you want to grow your economy, there should be policies where the banks are mandated to actually do this. In the Buhari era, there was actually a push for this. But, well, you know, speaking to Nigeria in particular, that didn't actually go well with the banks. Banks listen to the mandate, but never actually follow through on it. Most of their money still went to large corporations because there's still a trust deficit. Sometimes when cycles perpetuate themselves, it is very hard to actually break from it, right? Except, you know, there's a very, very aggressive push on policy. Regulatory, strict banking rules and high compliance costs. Now, also, as I mentioned, some of these things are in the bank's faults or the microfinance institution's faults, but there's something called your CRR. Earlier last year, when, you know, the CBN, speaking to Nigeria again, kept on jacking up its interest rates, they did not, you know, move the CRR, right? That's basically your cash reserve ratio. And this basically means the money that you keep with the CBN. The banks argued that it was too much money being kept to the CBN that they could alternatively use to loan to people. With high interest rate, it's very unfavorable for banks to actually want to loan to SMEs. Also, there's something called the asymmetric window, which is basically your interest rates for the whole of Nigeria versus what you can give as a bank to customers. It's kept on widening. The wider it was, the less impetus, right? Or the less interest the banks were willing to actually go into loaning to SMEs. So another thing is informational, right? On the other hand, SMEs tend to create these issues themselves, right? They do not record their financials, right? They also have probably very bad credit history. And this is a very recurring thing. I think about last year, there were so many people that I spoke to about get an Excel sheet, whatever you make a day, just write it down, right? Write it down. What you're spending in your business, write it down. It doesn't matter how you write it down, just write it as simple as possible so that it's easier to understand, right? And an additional thing is high interest rates, like I mentioned. Nigeria is in a very inflationary, you know, regime, so the interest rates are high. This discourages SMEs from to go into the banks, which is counterintuitive because it's kind of funny to me. If a bank, for instance, is loaning to an SME at 33%, because of lack of awareness and information and the rigorous process of dealing with the bank, which I can understand, SMEs rather go to money lenders, and money lenders tend to actually offer at even higher interest rates. So something else that I'll probably add here is the informational part. There is a bit of ignorance to how interest rates are being, you know, calculated, and that's something SMEs on their own need to understand. And there's also the FX risks for cross-border trade. People who are into import and exporting, trying to source trade finance in dollars actually tends to create problems. Now, for grants and subsidies, right, in 2021, the IMF, you know, allocated to globally to the world a $650 billion single digits interest. So it wasn't, so for some places they got single digits, some places it was zero interest, right? But Africa only received a fraction of that at $34 billion, right? And a lot of places in sub-Saharan Africa got like a fraction of even that $34 billion, that's maybe 1.5%, 2%. Imagine spreading that across Africa. That isn't going to do anything, right? So what are the cultural issues? They're highly competitive. Take, for instance, I mentioned the 𝐂𝐚𝐥𝐤𝐬𝐚, grant. I mean, you have hundreds of thousands of people competing with really, really good businesses, but at the end of the day, very few people are selected, right? Another thing you can see from grant and subsidies is the application time. Most grants tend to have very strenuous, rigorous, and lengthy applications. Sometimes it discourages people from actually applying to this. So most times when you're dealing with grants, trying to apply, you need a lot of patience and you need a lot of will. Now, with equity and quasi-equity, some of the structural issues that we have, right, is basically dilution of ownership. Most people are not willing to give up. Their equity in their company, right? They don't want to have some other person dictating to them what it is to do. So no one is willing to sell, part of their business. So that usually is always a structural issue for most businesses and most people. Another thing is regulatory. There are limited exits in Africa because our GDP doesn't scale as large and as fast. Productivity is quite low in certain regions of Africa. You have Western Africa and Eastern Africa being one of the major parts of Africa that actually bring down the current GDP of Africa in terms of productivity, right? Also informational, it goes back to the same thing with debt. Some SMEs and some startups do not actually tend to record their traction or their finances properly, which actually leads into issues with investors. So you need to avoid things like that. An additional information is investors expect high returns, right? So unlike dealing with a bank that probably tells you, oh, we need 30% at the end of the year, an investor needs way more than that. So what investors do in private equity and venture capital, keep it very simple, is they look at the country's risk premium. They look at the current risk-free rate. Your risk-free rate is basically what the government is offering as interest. It can come in form of treasury bills, right? So if you buy a treasury bill, whatever the rate is, right, most times investors want at least 3 times that in terms of returns, and that's very, very high, can be very, very steep for SMEs. Now, for hybrid and alternative structures, there's so many issues when you're trying to combine traditional debt, grants, and equity all together to try and, fund your business. The legal and financial structuring can cause issues when you're dealing with debt and equity. When it comes to the cultural issues, these are new information to people and it can lead to mistakes. There's also uncertainty. It requires a very long time for you to educate yourself before you actually get into it. Regulation. I mean, we just had the Startup Act that was passed about a year or 2 years ago. I mean, and we've been investing in startups for at least 2 decades now, and we just actually had a proper Startup Act. So you can see how this can actually create issues. Informational goes back to the same thing. Financial and legal know-how. A lot of people in Africa, rightfully so, concentrate on their businesses, but tend not to look at the other aspect of what they should know in their business, like the financial parts, the legal and compliance and regulatory parts. And innovative ways to finance your business. There are 6 innovative ways that I've put here. You have fintech microloans that you could get. In Africa, you have M-Pesa, Carbon, Branch. If you meet their criteria, you're likely to get money from them. You have microfinance and group lending. I mentioned LAPO, right? There are other Isusu clubs you can go to, adjust savings groups to actually get money from them to refinance your business. The guarantee schemes and SME funds is a good thing to always be in the local area. Most times, depending on where you are in Africa, the LCDA or your local government tends to actually put out, information for you to know about business funding or business programs that you can key into. There's also diaspora angel networks. You have the in Nigeria, we have the Lagos Angel Network. There's also ABAN, which is VC4's Angel Network. There's also ZD Circle. There's Serengeti Angels. There's crowdfunding and P2P lending. So crowdfunding, you have Rainfin, which is a blockchain crowdfunding platform. You have Fundable, you have Indiegogo, Kickstarter. There's Get Equity, there's Start Some Good, and there's Thunder Fund. Also, supply chain and invoice discounting for people who are actually in that type of business. You have CAPSA, you have the IFC C2F who's working capital. So most of these things requires deep research, right? And that's one of the issues that actually occurs with SMEs dealing with funding, right? Most are probably not willing to research. They tend to get some of this information from word of mouth. Most times when I tell people looking for funding, I always tell them it's better you do the research yourself in addition to word of mouth, right? Because the people in the first place that you are getting information from also sat down to do the research themselves, right? So actionable steps: prepare, reach, close. Preparing is gathering every information that you need if you're going to meet an investor. You also need to define the things that will interest the investor. So your KPIs, how are you growing? What are you spending to generate what income or revenue that you are on? What's your customer costs? What's the lifetime value of your user? The likes. Also, you need to craft a very good deck or plan tailored usually to each person you go and meet, right? You need to research, oh, I'm going to meet someone who is very, very, intimate with the ideas of climate change. You need to find a way to actually tailor your business plan to that particular investor. So you need to reach out also. I mentioned ABAN, right? You need to go to your local chambers, key in into the local information pool in your area, leverage platforms like Crowdcube, Rainfin, Kiva. I mentioned others in the other slide. Also access gatekeepers, right? Go on LinkedIn. A lot of people tend to always want to go and connect with a partner in a particular fund or DFI organization. No, that's not how you actually get things done. Look for the analysts. Look for people who are just a year or 2 years into their careers in that particular piece. Message them. They're more likely to answer you and give you information. Close. Know your partner. Your partner is basically, in simple terms, the agreement that you're least, or rather, the agreement that you're less likely to take, but you're good with, right? So when you know your threshold and where you know you're not going to budge, it will make it easy for you to actually negotiate, right? Clarify your covenants, right? This is basically when you're dealing with debts, right? Ensure you have a lawyer look at your term sheet or the agreements anytime you're dealing with funding. Protect your equity. It's easier to get lost in trying to raise. Equity is expensive, so you need to know what it is you're doing. Again, involve a lawyer. Spot red flags. Very careful. Look for hidden fees, cross-collateralization, and onerous terms. Follow up. Always keep on following up. I know some people be like, oh, I don't want to be too aggressive. It's your business. You're looking for money. Of course, there is a limit to how aggressive you are, but never ever shy away from following up. Provide timely updates, milestone reports with the people that you've raised from, and even those you've not raised from who have actually shown interest in you. Maybe you're too early for them, or maybe at that point in time, your revenue wasn't at the level that they would need to invest in. Always follow up on them and provide them updates. Now, these are resources. I believe I'm sharing this with the team, so you can always look at these resources. I have temp sheet checklist here, pitch deck outlines, funding readiness course, and also right here below is Grants and More. So Grants and More is a platform, basically Google Sheet spread. They have a monthly subscription plan, which is about, in Naira, about 5,000 Naira. They put lots of funding opportunities there. The WhatsApp number is there. You can reach out to the person, make the payment and have access to their database, so you can always get funding and grants programs that you can apply to. And that's it. Thank you very much.
Awesome. Awesome. So many nuggets packed into so little time. I don't know how you did it, but really, really comprehensive. And thank you so much to 𝐂𝐚𝐥𝐬𝐬 for that. I think, some of the most important things, right, that I, picked up, right, is, there are a lot of really innovative ways, right, beyond just, the ways that many of us would usually explore, right? There's that interesting play between whether to go for debt or equity, right? But I mean, looking at, fintech microloans, SME funds, supply chain and discount funding, so there's so much out there, right? And I think one of the most important things that you said was do the research, right? Find those right pockets of investment options, right? Be part of the right local information pools, communities, right? That make it easy for you to actually get access to that information, and also research your investors, right? Make sure you understand what's important to them, right? So I think there's a little bit of, as we work really hard on our businesses, right, we also have to be committed to doing that, the research as well, right? That allows us to really understand how we can go, for the right investment. So thank you so much for that as well. Okay, so I think it's getting really, really interesting. We're going to move on to our next speaker. Somebody who is a seasoned business management professional. So we're going to welcome 𝐂𝐟𝐫𝐢𝐜𝐚𝐧 Balogun, who is the Director of Strategy, Funding and Stakeholder Management at the Lagos State Employment Trust Fund, which many of us would already know. She has 12 years of experience across banking, enterprise risk, digital financial services, public-private partnerships. She's a trained lawyer with an MBA in global banking and finance, and she's had various roles across different industries. But in her current role, she leads high-impact partnerships, drives strategic initiatives, and oversees stakeholder management to support job creation and entrepreneurship across Lagos State. So please welcome to the virtual stage, 𝐂𝐟𝐫𝐢𝐜𝐚𝐧 Balogun.
Thank you very much, 𝐂𝐚𝐥𝐬𝐬. I'm very happy to be here. Thank you for the invitation, and good morning, everyone. I believe I'm able to share my screen.
Yes, you are, Mama.
Okay, thank you. Can you guys see my screen now?
Not yet.
Okay, I hope it is visible now.
Yes, it is. Thank you.
Okay, cool. So I must say that I really enjoyed the sequence of how this is happening, and it's important for us to first of all understand what had been shared earlier with respect to your avenues and where you can get this funding. Yeah, and then we're moving on now to what where you know where to get the money, the support. Then you start looking to what these investors want to see before they give you the money. So I would say that there are a lot of opportunities, as mentioned earlier, for the grants, for equity, for debt too. But what are those things that would really put you in that good space for you to be able to say, this investor gets me and is going to be able to do that? So the content here is we're dealing with how to make your business ready, what might make an investor say yes or no, and why and how to prepare your documents for your pitch. Going straight right into it, how do we make your business ready for investors? You have to create value. This is a no-brainer. What are you selling? What is the importance of what you're doing? And this value may come in handy with respect to return on investment, such as like interest, money that comes back, or it could also be impact. So I'm in the impact space, also in the money space, but more, like put together with impact, because we're not just trying to do what we're doing or get the money we're doing without really influencing people's lives and businesses. So ROI is return on investment that for me is on money and also on impact. So you can look at it as a business, as an entrepreneur in that sense, to say, what's the value I'm bringing to these investors? Can it be money? Can it also be impact that they are happy to always support you on? Then you must have a structure. When you know what you're doing, how are you doing it? Later on in the slides, you see where I say that your why has to be as compelling as your how, and your structure is your how. Your how is convincing, is compelling, it's telling them what to do, how to do it. And even if there were to be a detour, you can handle it. So you must have a structure. And then document your process. Document. As an entrepreneur, as a business, even as a normal human being just living your life, you should have, journaling. You should have a process where you're writing down the things that you're doing, how you're doing it, not only so you could come back and learn, but also when life gets at you and you have to drop some of those learnings, then you read them. So it's important for you to know that in making your business ready for investors, you have to have value, you must have a structure, and you also must have process. And then the things that make investors say yes, let's get right into it. You may have value, you may be able to want to solve for a social deficit or a business deficit. However, are you clear on this idea? Is this idea sustainable? Is it leading to strong revenue and impact model? I mean, if you were the investor, so again, we'll get to this part where I would give such inferences as to putting yourself in the shoes of the investor and then looking at it from a bigger angle. If you were being pitched to, would you say that it is clear and sustainable? Would you say that this idea, no matter how valuable it is, no matter how much structure you're trying to put into it, and no matter how much documentation you've been able to amass, because that's what's going to allow you to say, I can take this, I can take this, I can take this. Is it leading to something? Is it sustainable? Another thing again is, do you have sound financial health? Is that business, so you might have a clear idea, it might make sense, and you might be able to return money as fast as, a waterfall. But is it sound? Is that business going to withstand the pokes here, the societal glare here, or even your own critic as the person, or as an entrepreneur or as a business, before we now get to when the investors start having their own critic? So it must be sound, and these are what will cause an investor to say, you know what, I'm definitely going to put my money in this, whether it is debt or equity, because it is clear, there's a plan, and this financial health, the financial aspect of the business is sound. Now that's the quantitative side of it, which is also what was spoken to by the previous speaker, where to get the money, how to also go about it. This what we're dealing here is what will make you actually get this money, is the qualitative side of it. So a lot of investment has to go into this, and you have to see it as a part of what makes that investor say, you know what, I'm going to do this with you, not for you, but alongside you. And then the third one is the people, your target market, and you have to sell yourself. So I would say you is also a part of the team. Some people will be like, is my money in safe hands? Well, if money is not supposed to be safe, it's supposed to be turned over, used, and employed and made use to work. So what's that person that is making use of this money? Who are they? What do they know? What is their background? How are they willing to learn and do better? How much money have they even gotten before? And were they able to make good use of such money? And then the target market too. No matter how small your niche is, the market might be red. Maybe you're trying to, as a startup or an entrepreneur, get into this business that, oh no, you've heard so many people doing already. But there's a factor of you first. So it is you who is able to make this a leading and a strong base for your investor to say, you know what, let's co-create this together. Your target market is also very important. They want to know if the people that are going to buy from you or use your product. It's a no-brainer, right? And then the third one is the market opportunity, not just for your idea, but what can come from your idea. And again, it's going back to sustainability. We're in this era where one thing can lead to 10 other things. How does your idea as an entrepreneur or a startup, how does it fit into what can aid other things? I'll talk about it later too in the slides. There's the aspect of platformification, the technology fit. Are you going to be obsolete in a year? And then all of the money that has been put into, not even just money, even the stakeholder management, the people that has been put into you being able to get that platform, it's even just go down the drain. So what can come from you, from your idea? How best can others also appreciate you or even use your product, and then it becomes your money is working for you when you're sleeping or when you're even able to use your brain for other ideas. Why investors might say no? I only have two here because there'll be so many things and it can be quite subjective. But I believe that these two are quite objective, because if we were to place it on like a pedestal, would realize that, okay, poor communication, for example, is not okay. You can have the best idea, or you can have something that really will solve a problem, whether it's social or business, and you can't communicate it. You can't share what is going on. You can't convince. You can't even learn how to communicate in case you can't. Poor communication is a no-no. The art of speaking is one thing that we all have to learn, because you have to sell yourself as a person, much less when you don't have a business or if you work for a company. It's a growth thing. We don't all have it figured out. But when there are things at stake, such as solving for an idea, solving for the issues that we're having that is plaguing the world, and I can go on and on as to the different aspects of why an entrepreneur is needed or a startup is so needed in the world that we're living in today, we can add poor communication into the mix. So investors might immediately just be like, you know what? Nah, this is not for me, because you can't pass your idea across, you can't convince, and you cannot sell yourself as to why they should dole out their monies for you. Secondly, when this idea is not in alignment with the investors' priorities, and here I say that's okay. And that's because, as even the previous speaker mentioned, you should know who you're pitching to. You should know what they're looking to. You should know where their sectors are, where their geographical areas are, where the demographic is. You should know what they're looking to before you be like, hey, this is my 2 minutes elevator pitch. So non-alignment is okay. It's not a no that you should take as a defeat. It's that person's money is going into something else that is not focused on I need to look for those who are looking to support me and my own idea and the sector or demographic that I'm dealing with. So in a nutshell, with respect to investors maybe saying no or what they're looking to, it's more of being proactive and learning what is important to those people who really have the monies on ground. I'll give an example to you. I was in the GITEX Morocco. That's the Tech Nation event that usually happens in different locations. And it was interesting for me because we're having the GITEX Nigeria in about a few months in September. And I just wanted to have some understanding of what the investors were looking to. So at the investors corner, I spoke to a couple of people, and they were very, very precise. They were very straight, and I appreciated it. Even if I wasn't pitching a business, if I were an entrepreneur that was trying to get that, I would have gotten this idea of this is for me, this is not for me. Because if they are clear in their communication and in their alignment, why can't I be as an entrepreneur or as a small business looking to spend their own money, even if the eventuality is for both of our goods? So it's important that we get it from go and we're able to communicate it. Now, I'm going on now to the steps to creating a winning business plan and pitch, because your pitch is really what lets you know what they are looking for. Align as to why they should give you money, and what you are looking to do. And the very first thing here for me is yourself. And the reason is because I would have gone on to say, how is your business doing? Do you have a big idea? I think that at the point where you're trying to get people's money to push or scale a business, you should, first of all, see yourself and sell yourself so that they get you, and then you guys can have an alignment and get the idea out to the public. So investors want to know, is our money in capable hands? I said it before. Most times people will be like, in safe hands. No, it's capability here. It's competence here. Can you do it? Can you not do it? So you yourself need to sell your merits. You need to sell the merits of your team, and you need to buttress the fact that I get it. I've looked at it from your angle too. If I was the one who's going to get to dole out the money. So I'm telling you why my skills, why my experience, my qualifications, my learnings, and so many other things are going to be able to ably use this money. So you celebrate those skills. It's not bragging. It's collaborative investment. So a lot of things that you bring to the table may not be as equal to the money, but it's almost at par, because that's what they are also looking for. And you don't deny any of your shortcomings. In fact, you explain them and you let them know how you dealt with it. That shows growth, and that also shows capability. In that wise, nobody's looking for a perfect person. They understand that if you've been able to jump these hurdles or these hopes, it means that whatever is coming, we'll do it together. And then in pitching yourself and your team, you're charting the next steps, you're discussing your ambitions, you're talking about the improvements that you can do for yourself and your team, the organization. And then they're convinced that, well, a part of this money is not going into things that we cannot account for in another 1 year, because, well, it depends on the timing or the M&E or MEL that you want to do with respect to the investment. But in charting your next steps and your improvements, it also tells them who you are and the kind of plans that you have for the money and for the business. Then we talk about market research. Yes, I know that these are the important things, and you should have gotten all of this done way ahead. You know, data equals potential. You have to speak to numbers. You need to ground your product in hard data. There's this sense of excitement when an investor knows that you're ready for action, that you're ready to do this, and you're backing it up with the numbers, and you're saying, you know what, 5 naira is going to create 5 jobs. And in fact, if I were to push or do something else, you can do as far as seven jobs, and the reason is because of this. Or 5 naira can give us the scalability of 10% in this, that. The reason is because there's a match. There's a marriage between your idea, that potential, and the fact that the market is ready for you. You should also make sure to cover the following in this research: the hard truths. And I wanted to highlight some of these things, like embolden them, but I was like, let's not look like it's coming across as too hard. But the truth is the truth. What do you want? Why do you want it? And how will you use what you want? If the market is not saying anything good, then you cannot really speak to the hard truth. So there are a lot of businesses that are already read. It doesn't mean that you can't go into it. But when you look at the data and the potential of it, perhaps that's not what you should be pushing for. I'm not saying that everyone has to be, bringing out the rare feather out of the hat. No, it is that you must be able to capitalize on what you want to do, why you want to do it, and how you want to use what they're going to give to you. And then the market and the growth potential too is very important. What's the capacity of your product or your service to increase demand and sales and impact of why that 5 naira that was given to you could be multiplied over time. You must also speak to identifiable risk and mitigation, the legal ones, the potential pitfalls, even if just one, just so that they see that you're proactive about this. There are a lot of issues when it comes to startup. There's a Startup Act in Nigeria, for example. Other countries, I'm not sure about what you have, but I'm sure that there will be some legal formulation that backs what you're supposed to do as an entrepreneur or a startup. These are the things that you can speak to, particularly if you have investors internationally. and you're able to let them know that we see this, we have been able to identify this, and these are what we're putting in as mitigation. And we hope that that sits well with you. Competition too is part of what you should speak about. It shows confidence. When you not only should you demonstrate that your service or your product is competitive in the market, but you should also own the fact that this is good for business. Saturation isn't a bad idea, like I said, but it's important to get things clear from the beginning. Your business model and your revenue model. This is important. Some businesses are not scalable. Therefore, now. Is that really what you want to fit into? Investors are not looking to that. Like I said, the world we obviously we're moving from that. We're moving into these spaces where 1, 2, 3 things coming together to form something larger. It's like the Autobots. When you see the different parts of it. If one thing were to not fit into that, it will reduce that whole structure. So your skill, your pitch, or the fact that you're selling to this investment to get their money for your idea, it rests on how you're able to. Again, I'm talking about the how. The how is so important, and I said before, like your why has to be as compelling. We might have the best ideas and the best intentions towards starting a business or having this idea as an entrepreneur. But the how is what gives us the longevity. The how is the business model. The how is what gives us the platformification and processing, the scalability, the technology fit, such that you're not obsolete in any time. That you're able to morph and fit into things. That's what investors are looking for, because then they can get their return in as many times as possible as the years go by, as opposed to, we have to cash out now because, we don't see you moving forward in another 2 years. The pricing and fee structure is also important. You need to explain that in your business model. Again, when somebody gives you money, it's because that money has to be turned over for something. Yes, we're looking to impact, we're looking to touch people's lives, but the money that is given to you, whether it's long-term or short-term, must also come back. So you must be able to expatiate on your fee structure, how you're also going to get some money back from your idea. Services and products, pricing, whether there's a premium part of it, which is also speaking to your target market, or if you're in niche service. You also have to speak to how the service is speaking to revenue goals. So you say, like I gave the example before, if you gave me 5 naira, I'll be able to turn it over to 5 days or 7 of that. You also have to project for investment, including amounts and what to expect. And you have to be very realistic in this. There's no reason to, because you want to get somebody's $10, or you want to get somebody's which other currencies do we have right now? Uganda. You should be able to be realistic about it, to say this is what the market is saying, because data is saying this and we're projecting this as our ROI. That also gives the investor the confidence that you know what you're doing and your feet are firmly grounded. You're not just like, you don't have your head in the sky. You should also talk about paying close attention to investors who are aware of irregularities. So it's important for you to know, again, we spoke about that, the people that you're dealing with, you can't just like bamboozle your way through things and be like, oh, but this is the most amazing idea, why don't you see it? It also comes down to the communication and the scalability of who you're selling. Because again, it's money for money, no matter how long the period that we're agreeing to. So the next is the sales strategy. An investor will want to give you money when you know that you have a strategy, you have a plan to bring in this money. And it's not just about how attractive your business is or how beautiful the solution is. I mean, we have so many funds dealing with climate, reconstructing, we have green economy and the likes. Everybody knows how attractive it will be to solve for our social issues on flood, deforestation and everything. But people they don't have the strategy to go about it. It's like we really need to communicate the strategy of getting this done as simple as possible. Of course, there's no sales aspect to some of these social impact businesses. I'm just giving that in a general idea. So on your sales strategy, you have to convince your potential investor of your why and your how. And so your marketing channels, how you want to sell, if you want to have a niche thing, well, we all have like different aspects of how people get their business to people to their market now. You could also put that into your pitch. Your growth metrics, your customer acquisition cost, again, realistically, your conversion rates and everything, you have to let them know that this is the plan for this. And if some of these things were to be, because some of them can be quite costly, you also have to put in your strategy how you want to say save cost or improvise for other things. Your sales process breakdown too is very important. What is the journey from a lead to a sale? Your investor wants to know that. You might assume that people will say your idea and they'll be like, you know what, I'm down with you. I'm ready to buy this. But the investor needs to be convinced on that. And that's where communication skills also has to come into it. So you need to let them know that this is not just the plan to broker this partnership. This is also the plan to close that deal. Investors are also looking for growth potential. So it's not, again, I've said this, it's not about the now. How well would you do in another 3 to 5 years? What are the metrics at the different stages of your growth, your customer journey? Are you going to be able to return to the investor either for more money or for even return that you have been able to do in a shorter period of time? Again, it's important to justify your funding needs. And this is where I say your how has to be as compelling as your why. I keep saying this because this is exactly the reason why you'll be able to get the money. You're solving for something, that is your why. But there's a reason for me to be an entrepreneur. This idea is going to bring in a so amount of money over the next 5 years or impact over the next 10 years. But this is how I'm going to do it. In justifying your how, that is exactly the nexus of where your money comes into it. And all of what we have said earlier are these things that will allow you to really position your how that gets you the money. This is my last slide. And I wanted to put this in because it's a possibility of you also, selling your business off or moving off to something else. Entrepreneurs are they are exceptionally brilliant people. They always have one idea or the other, and as soon as they're done with one, impact is done, money has been made, they're looking to something else. And you'll find that the really resilient and strong entrepreneurs are the ones that a couple of the things that they had built or even sold over the years has an impact in what they're also doing currently, which also speaks to why you should look to the sustainability of what you're doing over the years, because as the years go by, you'll find that the people who invested in you in maybe 2000s, in 2020, and about another 20-something years later, they're looking at you and saying, this is the reason why we gave you $10 20 years ago, because we see that another idea that you have brought together will make sense because there's a link here, there's a connection as to why you're doing something. And as at that time, your how has been institutionalized. You've seen your process because you've been able to return to them, not only in money, but also in impact. So in your exit strategy, no matter the idea, you should plan for it. Fundraising progresses, it moves from the different stages of getting money, and investors usually want to know what the deal will be. Are you going to buy it back from them? Are they going to take it off your hand when you go public? These are things that you need to also just maybe not explain too much, just touch on in your pitch, because some investors are also they're also interested in that. So you give a sense of what your company will be getting at in another few years, and what this investor will be getting if they were to give you that $10 now or their 50,000 naira now. So they might not really care so much about how you want to go about it, but they want to know how they get their money back over the period of your relationship or your agreement. So it's not for you to be like, oh, I'm definitely going to in another 5 years sell off my stake or buy it back from you. No, it's just a part of the necessities of fundraising to give some insight. And if the investors are interested further in getting to know what the method will be or the style will be, then you guys can have the conversations together. I hope that this few slides of mine has been able to convince you as to what investors want to see before they do drop their money with you. And I'm going to end by saying that it's really about you, your idea, why you're doing it, and how you want to accomplish this. This will put you in a solid position for the investors to say, we really need to do this for you, whether it's in debt, even if they're getting their money back over maybe like every month or every year, or whether it's in equity where you guys have a longer tenure plan, or even if it's in grants, which is usually quite easy because if you don't sell the qualitative part of yourself and the business, you're not going to get it. So in ticking the boxes as to what puts you in that position, I believe that investors will be very happy to go along with you on your fundraising plan. Thank you very much.
Very much. Thank you. Really, really comprehensive. Expected nothing less. Thank you so much, Sharifa. I think, there's so much to take from that, right? What is the value, right? Ultimately, it's the value that you're going to give to someone else, right? Putting yourself in the shoes of an investor who has money, right, to put somewhere. He wants to put it in a place where he's going to get a return on investment, right? So, what is the ROI? What is the impact if it's not the ROI, right? That's important to that investor, right? I love that, talked about creating a structure, documenting the process, market research being really, really important. And that's, again, research being buttressed again. Data, right? Outlining what your actual ask is, right? And then also, something that's important that you mentioned is, competition. Right? Competition is good over and over. We see people saying, oh, there's no competition, right? For the product that I have out there for my business, there's always competition, even if it's adjacent, right? And maybe not direct. And so being open about that and talking about it, right, is actually a good signal because it shows, good awareness of the environment, your own self-awareness, where you need to sort of, be more aggressive. And then also, just, talking about sales strategy, go-to-market, unit economics, growth metrics, and then, of course, exit strategies, right? I think this is something that a lot of investors have been talking about, especially more recently. How do we exit? Because ultimately, it's about return on investment, even if it takes 10 years, 5 years, or longer, right? So is that maybe an acquisition? Is that maybe going public, maybe in years to come, or maybe management buyback, right? So just having that understanding of that long-term potential as an investor, as an entrepreneur, right, gives a bit more comfort, right, to an investor as well. So thank you so much, Sharifa, for that comprehensive take on what investors would want, right, before they actually part with their money. Okay, so as I said, as we go along, we're just adding layer upon layer, right, of insights, of expertise, right. So we would love to jump to our third speaker for the day. So please welcome David Adeleke, who is the co-founder of Zeeh Africa. He's a trailblazing fintech innovator and the founder and CEO of Zeeh Africa, an AI-powered open banking platform that is revolutionizing how financial institutions in emerging markets access and analyze data. He has over a decade of experience. He's built groundbreaking products in credit scoring, digital identity, financial inclusion, especially for the underserved. At Zeeh, David leads a team that's solving critical financial infrastructure challenges by delivering real-time, secure insights through AI and open banking. I think we have a lot to learn from David. And so please welcome him to the stage for Are You Ready for Funding? Let's check together. Thank you very much.
Yes, okay. Thank you very much. Thank you so much, Olu Sheye. Nice to meet you once again. Thank you, everybody. Good afternoon. So before I proceed, let me do a little mic check. Can everybody hear me? Am I audible?
Yes, I can hear you.
Okay, awesome. Thank you very much. Please, could you confirm how many minutes I have on the clock so I could like work with your time?
20.
Come again?
20 minutes.
20 minutes. Okay, thank you very much. Okay, so I'm going to try to make my session a little bit practical, because at first I was thinking of having more like a conversation, but then when I spoke with the organizer, they want something similar to presentation, so I was able to like come up with just some bullet points to like guide the flow of the conversation. So permit me to share my screen. I'm doing that right away now. Please let me know as soon as you can see my screen. Okay. Let me put this into presentation mode. Okay, so basically what we'll be talking about is, I mean, the way I've been able to recoin it and making it a practical session is we'll be talking about some real-time practical strategies, right, that would enable you for sustainable growth in a bid to like secure funding. So what we'll just be talking about basically is why capital is essential to SME success. That's to businesses, why we need capital. Then what are the challenges to face? Then basically what you will learn today. So first of all, one of the major things to start with is to understand your financial need. I keep telling a couple of startups that I mentor that it's not all startups that need money. If you can't get to the stage where you identify whether you need money, why you need money, what you need money for, and what kind of money do you need, right? If you can't answer those whys, right, it's advisable for you not to go outside to collect money. Because I know it's an interesting thing to know that, oh yeah, you have something $1 million in the bank account, right? And you don't even know what you want to do with the money. That money comes with a lot of responsibility. I just want to like lay the ground foundation first before like we go deep into it. Money comes with responsibility. Any investor that's giving you money, right, they are giving you not for you to use anyhow you like, but then it's expected of you to, number one, manage the resources. Number two, whatever you promise, you know that you, beyond all reasonable doubt, you put in your efforts to deliver returns. Then number three, right, yield results or yield interest for them. The money is not just for you to say, hey, okay, you give me 5 million, I've blew it or I bumped it to like 2 million that is left, take your money back, business is not going fine. In as much as if there is some level of accountability in that, right? But then they investing in you means they believe in you, that you are capable enough to make money for them. So know those little why. So basically, going by my slide, right? First is what stage is your business in? What stage is why we're using SME now is there is this buzz around it's only startup, you're running a tech business that makes you entitled to have funds. Is not, I invest in a lot of traditional business. You'll be shocked that I invest in agriculture, in farms, like, and they have zero technology map on whatever they are doing. So that's why we call it SMEs for this session, like small and medium enterprise, right? Then how much capital do you need and what do you need capital for? Do you need, some people, right, you might not even need your investors fund at a lump sum. It might be for them to be sending you the money in months. Literally, it helps a lot because you yourself, you can use that to tie down your burn rate, to calculate what your burn rate is and know what you make on a monthly basis. It's another form of accounting, which I do. I mean, I do it a lot and it really helped me. Then what kind of funding do you need, right? Are we looking at equity? Equity, I believe we've, in previous speakers, I've dealt with whether it's equity or whether it's debt. Are you willing to give a portion of your company? All right. The type of SME funds that are available. So the fun fact about funding now is everybody does not need funding, one, and number two, everybody can get funding. So I would pick this in no personal order, right? Sorry, no particular order. The first kind of funding you can do should be bootstrapping. So now you're saying that you want to start a company. You could start or with your own personal money. Should, in case you don't have enough money, right, your time you're putting into your company, like into the product they're trying to build, it's also another form of bootstrapping, right? You could get a job, and while you are getting your salary, you say, okay, maybe 50% of my salary is going to be set aside for these products I'm building. Because imagine you're coming to meet me as an investor, you can share the idea, the idea can be mind-blowing, and you've not taken any step. I've not seen any serious commitment in you, either in time value or in monetary aspects. And I get to wonder, oh, are you really serious about what you're building? So most investors want to see, oh, what level of sacrifice, what level of investments as a person have you put into the business? Then number two would be friends and family. I believe everybody has friends and family. This gives a lot of momentum, and it gives a lot of, what's it called, belief to anybody you're speaking about in terms of fundraising. We're building these X and X products, right? We've gotten this early traction, we've identified this problem, and we've been able to create this solution, right? Then in terms of our asks, we want to raise so money. However, we've been able to close whatever percentage of the overall money you're trying to raise from friends and family. This kind of confidence that it gives to the investor is, okay, this person has been able to gather the courage. He has people that are willing to back them, because the first person that can easily give you money should be your friends and family. And that means that also speaks about the kind of friends you want to like venture in. Your friends don't necessarily have to give you $1 million. It can start from maybe the first 5,000 naira, 5 million naira. Yeah. When I was starting one of my company, the first check that someone wrote, one of my friend, was 5 million naira. Interesting. At the early stage, when it was just an idea form, we had not started anything. And when we wanted to go ahead to raise the little round which we raised down the line, that was one of the major things I anchored on, like, hey, okay, we've been able to raise. I mean, imagine you want to raise $1 million and you're telling someone you've collected 5 million naira, which is just like $5,000. It's something, it's a traction, no matter how little it is compared to in magnitude of things, right? Then there are grants, a lot of grants out there, right? It's all depends on, as the founder, how much time are you staying up, right? In terms of putting in the work to search for grants and competition. There is a lot. Then now we'll go into the bold move of bank loan and microfinancing. So that's a form of debt equity. So when you're trying to raise money, you can, it still goes back to the first question of what kind of funds do you need? Do you really need all equity? So if you're in a debt business, maybe you're in a lending business, right? You don't want to raise all equity. You can raise a portion of equity for building your infrastructure and keeping the operational flow running. But then you can now raise the other part as debt, wherein you are using debt to service your debts also. Then I won't spend much on the angel investor and VCs, crowdfunding platform. I think I can mention a couple. One of them should be Get Equity. I think they are doing pretty well. So then we have revenue-based financing and factor and invoice financing. I think my time is short and I have a lot on my slide, so let me just move in. So what are smart financing strategy? One of the first way to do this would be you need to understand how to diversify your funding source. So one of the ways to diversify is either using the debt equity mode. So you go for certain debts, you go for certain equity. Then you could use different term sheet in terms of what kind of funds are you raising. Are you using safe? Are you using convertible? So if you're telling an investor that they're trying to raise funds using convertible notes. I noticed a couple of them feel a little bit secure, right? Okay, because basically what convertible notes means is, hey, I'm giving you more like a debt capital, and at so year, maybe after a year, it comes with maybe 5x rate, 5x, sorry, 5% to 80% interest rates, which is payable as just the interest alone, right? And maybe the capital is then converted to what's it called, to equity on the long run, or if not, they can pull in their capital. I mean, it just depends on the kind of agreement that's on the term sheet. But what that helps the investor is, oh, it gives them like a leverage, especially when they are venturing into a business that is still at a very, very early stage, knowing fully well that, oh, this person is committed to like returning the interest plus the capital. Then there are match funding. So these are like programs that a lot of, I think the USAID do some of it, right? Then I think that so the GIZ also do something like this, if I'm not mistaken, right? Wherein they said, hey, you're trying to raise $500,000. You have to bring in a matching fund. Maybe you have raised 250 yourself, or you have someone that is raising 250, or you've been able to save 250, right? Then they match up with the extra 250 to make it 500. So then another thing that makes you have an upper edge when it comes to the strategies, understanding the cost of capital. That's okay, you're getting this capital, what are you giving up? Are you giving in interest in this debt equity? Are you, what's it called? Are you giving up equity of your company, right? Then you want to prioritize non-dilutive capital early on. It's a very important role. So yeah, I do like this slide, but I just say, let me just put it here. So I'll just run through it, because one of the major thing I think it's a mistake I started as an early founder, right, was I was building to be investment ready till I figured out that, hey, I'm doing it the wrong way. So that's why I left it there. So it shouldn't be to build to be investment ready. I think it's to build to either service your customer or to make money or what have you. Because most founders, we kind of now mix our road and find ourselves in the web of, we're trying to build a company to impress one investor. We're trying to redesign our landing page to speak excellent. It's good, right? But that gets to the point where there's a thin line where you lose the touch of, hey, are you really building a product for customers to use, or you are building a product so that you can be attractive to investors to invest money, right? So that's why I left it here. So but just to run through it, because it's also a very vital, important part in fundraising, right? You need to have your solid business model. It has been explained already. Traction, it has been explained already by previous speaker. Your pitch deck, then your clear fund usage. What do you want to use the money for? How do you want to give them the money back? So there's something called Article 9 fund, right? It's not popularly known, but it's something I think people should look into. So there are venture-backed platforms. Sorry, there are some VCs or some funds that they are created specifically for impact. So this kind of funds is not the general funds that you're going to like convince what's it called? You're going to convince an investor that, hey, okay, I'm going to give you 40x return in 5 years or in 20 years, right? What matters to them in terms of KPI and also to their LPs is what impact are you creating, right? And also, I mean, they want you to stay cash flow positive, but then they are not so big on how much returns you are giving them. They want to know how many lives are you touching. So it's something that everyone needs to look into their businesses, right? What is that impact mode that your business is trying to like offer to the ecosystem globally, right? Then what's it called? You can now include that into your deck. I'm sorry, 1 second. So okay, then another part to mention, right, just to digress a bit, is you want to do a little research on who is the best fit to come in to invest in your company. I've turned down a lot of checks. I keep saying it right. Why? Not because I don't need the money, but it's more of, okay, are you valuable to me? Apart from the money you are giving me, what other benefits, what other assets are you giving to me, right? And are we going to do well? So I'll just put this up here for us to see different platforms that we can use to like search for platform for fundraising. So for grants over there, loan, equity, crowdfunding, then accounting tools, which is very important. So I forgot to add our very dear old Nigeria accounting tool, which is Times. They are very good. I think that people should try to use them. I'm not marketing, please. So, but it's just why I'm mentioning it is it's very good, so that when you're talking to an investor, you're just giving them, even before they ask, hey, what's your number like? Okay, look at this. What's this like? Look at this, right? So it helps you put your book in order. So the next part would be building relationship with founders, right? This is the way, I mean, I'm not going to teach anybody how to like talk to founders, right, in terms of raising money, but there are just some certain guidelines that helps and makes the work easy. You could go directly if you know you've already gathered a lot of traction and you know you have a very short window to raise your money. When you're reaching out to them on LinkedIn or events, you can go, hey, I'm so person, I've done this, talk about what you've done, right? I'm building this, right, to solve this problem. In one sentences each, then so far we've been able to accomplish this, right? What you're saying that you've accomplished could not necessarily be maybe you've made money. It could be you've had 5,000 wait lists, you've done market research, you've determined the demand, you've secured partnership with so banks, right? And I'm raising money in this expected duration of time, right? Then I'm looking forward to hearing your thoughts if my products aligns with your investment thesis. Quick, precise, you don't want to waste their time, right? Apart from going directly at them on fundraising goals like that, right? Another important thing to do is you want to network with them and build relationship. What does help you to do? So the process of you building relationship means that hey, okay, we are doing this, you've introduced yourself, you don't necessarily need to tell them you are raising money. Best way is you need to tell them, you need to ask them for advice. Can they intro you to someone? Let them feel like they're already part of the company. So the moment when you are about to raise money, you'll be like, okay, so far they've been able to understand you, they've seen your work pattern, they've seen how accountable you are, right? And then apart from them, they've seen that they're also an asset. It's one big thing for an investor to see that they have connects to help your company grow more than them just giving the money, right? Because it means, oh, they're invested in the business and they can also support the business to grow. So you want to like build relationship with them. Then another important part, easy way, right? It's not easy anymore, but then it's still one of the easiest and fastest ways, join accelerator and incubator. What this does is it really helps you in what's it called, in getting some form of validation from the ecosystem at large. So I mean, what's the biggest asset any YC company have? If you go to LinkedIn and you check any company that has gone into YC, the first thing you see is ABC in brackets, YC batch something. Techstars also, ABC in brackets, Techstars, the year they got in, Noskin, etc, the right. What that does is it gives anybody, even both, not just the investors, right, customers, potential partners, it gives them that confidence that, okay, yeah, this person is being backed by some bigger players in the industry. So there are a lot of accelerators out there, more than you can think. Once you use F6S, VC4A, a couple of others, right? You get to see a lot of accelerators. Just keep applying. Then take the accelerator serious. It's another very thing. And there are a lot of them that might not even give you money. So, but the fact that they will give you access to certain offers that would help you save money. So say, for example, when we first started my previous startup, then we got into one it was still at the very early stage. We were one of the first entry people. They were not even giving money as at when they just started. Now they're giving money and they're doing great, right? But one thing they gave us was they had partners with AWS, Notion, what's it called, HubSpot, a lot of those top SaaS products that we need to ease our operation, right? And they gave us credits. Up to now, I've not exhausted the AWS credits they gave me, like I'm talking of 2-3 years back right now. And I know how much that has really helped our business in the sense of removing our cost of operations, especially with our cloud services. So yeah, it might not be necessarily money. They will give you what's it called, access to materials, tools, networking tools, mentorship also, right? That helps you. Then one, if you're a founder, I know some people have certain things against LinkedIn, right? As far as some people believe it's a place for fake show off, right? But then if you're a founder, you are not keeping your LinkedIn profile up notch. So you want to leverage LinkedIn 100%. Then lastly, you want to keep your funders updated. See, it's as good as at the end of the month, you are not doing. It's something I also struggled with at first, that I had to like get someone in our team to, hey, okay, you're the one that is responsible for this. Just be compiling the updates every month, right? And be sending it to me. It's as good as, oh, we didn't even make sales this month. We face these challenges. Send it to them. Everything, all your reports doesn't necessarily have to say we did good numbers this week, we did X numbers this month, right? But that regular, consistent updates, right? And one of the person I even picked this one from was Shola of Paystack. Is something that is very good at. That update that he gives to his investors. I've been able to see a couple of it in time past, and I'm like, okay, yeah, now you see why Paystack is what it is right now. And then common mistake to avoid: you don't keep your record, you don't even understand what your investor need. Like, you need to research. Not all investors is meant for you. I keep saying that, right? Then there is lack of transparency or readiness. Then you're asking for too much or too little. I don't want to go into the part of you've not started anything in your company, you've never even tested the waters, you've never started, you don't even understand the market, and you're out there looking for $10 million. They will ask you, hey, you're either too early or you're not ready, one of the two. So yeah, I'm wrapping up already. So case study, I think this is optional, but I think my time is fast spent. Can I confirm how many minutes do I have on the clock?
You've got 2 more minutes.
Okay, 2 more minutes. So I think I would just keep this because I already pointed out a couple of successful SMEs that secured funding, right? A story of a couple of them. I mean, I've used myself as an example. So another last part is just to focus on the smart funding approach. So key takeaway in conclusion is, number one, you need to know your numbers and your needs. Let me just go a little bit down on these numbers parts. As a company, I mean, as a founder, if you're looking at raising money for me, first thing I want to know is, do you even understand your unit economy? If you can't understand your unit economy, it's going to be very hard for you to hit profitability on the long run. Not even hit it, you won't even know when you're supposed to be profitable, and you'll be able to optimize yourself for it. So unit economy in the sense that, what is your COGS? Like, what's the cost of goods sold, right? The baseline, like, no matter, even if it's service, if it's a product, if it's either physical or non-physical goods, there are still certain expenses that you pay for, right? What is that thing that you are spending on to get 1x of your products out there? Then the next thing is, how much are people willing to pay for just that one version of, or that one product of that 1x of that product, right? Then from there, you can now know what is your profit margin. Are you making a 10%? Are you making 100%? Are you making 500%? So once you can understand that baseline of what your numbers is on the unit level, right? So no matter if you have 1 million customers, you, in the back of your head, you already know what is my worst case, that for every customer, how much am I making from them? So with that, you can use that to create a very good roadmap. So that's where you can now apply that to your market size. So a lot of people just put market size on their deck they just do research, and they don't even know how it relates to their business. Market size is a really, really important research in your pitch deck, in the sense that you want to know what's available in your market, like what's available for you to obtain and what's available for you to address, right? Then it's from what's your SOM, that's a serviceable, obtainable market, right? That's what you now align it with your unit economy, that, oh, okay, if I'm going for 20 million of this market, of a 2 billion market, right? How do I go after this 20 million? How much do I need to spend to take maybe a 5% share of that market, right? And how much do I get to make? So with that, it helps you, it gives you a good understanding, right? You need to work with data and number. So don't rely on one source. That you need to build trust and credibility. It's very, very important. So building trust and credibility also means another way of doing that is by showing up where it matters, not necessarily where it matters, but just show up. Let them get familiar with your face. Let them see you. Be the main proud marketer and seller of your product yourself. Right? Talk about it. Let them see that, okay, yeah, you are in it to the last end. Then last part is stay ready. So I think we're already a little bit out of the winter, but now from the funding winter that we went through, it gave the investors a lot of time to like rethink their positioning, to reposition themselves. So mistakes they did in the early buzz of 2020, 2021, and early of 2022 won't repeat itself anymore. So now they take time out to vet startups well. So you want to stay ready. You want to have your data room. So there's something called data room. Data room is where you have all your documents compiled together in one place, from your shareholders agreements to your directors agreements to your company registration and what have you, right? So you want to stay ready. So thank you very much. I think questions can come in later. So this is me. Thank you once again.
All right, thank you so much. I think, very, very practical, and really great to hear, right, stories from somebody who has raised, right? And thank you so much for, sharing tools, platforms, right, that allow many of the people on this call, to access, the information they need. So I think you shared tools for grants, for loans, for equity, accounting tools. These are real lifesavers, right? I really liked how he also talked about, relationship building, right? I think, people want to do business with people they like, right? It seems like a no-brainer, right? But if I like you, right, and obviously if you have a good business, there's more likelihood that I want to have a continued relationship with you, right? So it's important to network consistently. It's not a one-time thing. It's not a one-time, when you need that urgent, 2 million, right? That's when you reach out, right? It's a constant, keeping them abreast of progress. As David said, right? Just to say, oh, just checking with you. We've been able to do this. We've just launching our, second version of this. Oh, by the way, we've been able to do this, right? Just keep them abreast, and so that when they keep making their minds up more and more over time, that this is something that they actually want to do. He talked about LinkedIn, very, very effective. In today's, I think they're one of the fastest growing social networks, but professional social networks, even though there's a lot of bragging, but it's also a really great way for people to sort of connect, right? And quickly find out information about you, because it's all about trust, right? If I see somebody who has added me on LinkedIn, I can easily find out what they've done. Is this someone who connects with what I'm trying to do, right? And always don't just add someone and connect with them. Send a little note with that. I think LinkedIn allows you to do that, right? So that they just have a bit of context, because they have probably hundreds of people who connect with them in those ways. But yeah, knowing your numbers, unit economics, very, very important. Okay, so I think, we have to admit that we have had a super, super insightful afternoon. Kudos and thank you to our three amazing speakers. So now we want to open it up to, to the floor. We want people to ask questions. This really has to be interactive. So if there are things that you really need to dig deeper into, please, the floor is open for you. I think, on my end, I just wanted to ask if we still have Juwon on the call, right? When we're speaking real talk, right? What would you say is one of the most common mistakes that you see founders make, right? When trying to raise funding, especially from institutional investors. So things that people don't need to make as a mistake, right? But you keep seeing over and over and over again. Is if there are one or two of those that you can share with us. I don't know if Juwon still on the call with us. Okay, great.
Yeah. Yes. So this is a pretty easy question for me because I happen to take a particular course in SDC Startup School on this particular question. It's your market opportunity. That's the one thing, you know, a lot of startup founders, a lot of business owners tend to make the mistakes, right? You need to be able to quantify your market, not based on what you see online, you know, from research from maybe McKinsey or maybe your BCG or more other independent consulting agencies, right? You need to be able to quantify based on simple things, your price points for the service or product you're selling, right? And the actual obtainable number of people you can sell this to annually, right? So you need to be able to do that. That's literally one thing I know a lot of people tend to make a mistake. When you open a deck or a business plan, you see, oh, my total addressable market is $140 billion. The serviceable addressable market is maybe a fraction of that, that's maybe 40%. Then we hope to capture maybe 2%. First off, to be honest, even if you hope to capture 2%, you likely in practice won't capture 2%, right? So it's better to quantify the numbers based on what you are likely to be able, or rather the amount of people you are likely to be able to service, right? Even if it is, oh, we can reach 100 people this year, it's fine, right? Just show the amount of people you are likely to, you know, scale up with to reach certain numbers. Most of investors already know how large the market they are playing in is, right? I mean, it's a different thing if this was the 70s and some markets were still obscure to like lots of people. But when 2025, trust me, there's no market that any venture capital professional doesn't know about. I mean, you can call the most obscure market, they'll tell you we have data on that, right? So what we want to see is how much you can generate annually, right? That makes more sense to us. That's where we can get our valuation from. That's where we can actually see and start asking more broader questions around your unit economics, right? Looking at your growth pattern, your go-to-market strategy to actually get this number. But when you give something as obscure as, oh, we want to get 10% of the Nigerian population, the question will be how, right? I mean, 10% is, and when we think about it, startup founders tend to start their companies mostly from Lagos. And we all know that Lagos isn't even up to 10%. And if you're and most businesses tend to struggle outside of very commercial areas. So this is one thing. One of them is market sizing and market opportunity. The second thing is it is the use of funds. Now, a lot of people do put the use of funds on their deck, on their business plan, but the mistake that they actually make is when it comes to the financial model, and I've seen this, right? So when you build a financial model, you want to be able to estimate your funding size. No one actually, and I'm saying this, I think I've seen lots of financial projections, and I can count on just one hand how many people I've seen who actually estimate their funding size based on how they're going to use it and how that actually tracks into their financial projection for the next 5 years. I think lots of people tend to avoid that based off the complexity of the financial model, trying to do that. But it's something you should do. It's easier for me as an analyst or an associate, right, to be able to look at, okay, you are raising $5 million. You've already shown me how you're going to use the $5 million rather than telling me what you want to use it for. Okay, you've told me what you want to use it for. I can likely guess what you want to use it for. You want to use it for operations. Everybody needs money for operations. You want to use it for marketing. Those are the two most common things you see on a deck or a business plan, right? But the mistake a lot of people make is not actually putting that into the financial projection. Let me see how you're breaking it down, right? If I give you $5 million and you say 10% of 5 million, that's 500K, right? Is going to technology. Okay, show me, right? Put it there. What licenses are you paying for? Who are you hiring? That sort of thing, right? And a lot of people tend to make mistakes. So those are the two things: market sizing and also showing the use of funds and how that's going to be used over a period of time.
That's amazing. That's amazing. And again, very, very practical. Literally something that, you know, right now, many founders on the call can literally change and see that impact immediately. Thank you for that. I think it's you know, one thing that comes out of that is that just be as open and as honest, right, about the potential, right? as opposed to, you know, being vague and then maybe sometimes saying things about the market that you feel might make it more attractive or bigger, or, you know, and as Johan said, many people can see through this, and that puts them off and makes you not look like you understand your market as well as you should do, right? So please, as we said, this is very, very interactive. This is about you, your business. Many of you would have tried to raise funding in the past, or maybe are thinking about doing it pretty soon. So please, any questions, anything that you want a bit more insights on, please, this is the time, you know, with our 3 experts on the call. Just as a reminder, you'll be able to access your certificates from tomorrow. So after this call, they'll be made ready and shared with everybody directly. Okay, so I think we have one question from Timmy Topper. Please go ahead.
Hi, thank you so much, Lucia. Nice to meet everyone. My question is regarding, and I think I'm just going to open it for both all speakers to take on. My question is regarding on the point of due diligence for the investor side, right? It's, basically, when you want to reach out to investors to basically invest in your company, sometimes the question is, it's a long drawn out process. You reach out, you have a conversation, you do your pitch, you send documentation, they go to your data room, you see conversations, and then silence. When maybe they might say, okay, they'll get back in a week or 2 time. Do you think it's okay to, when you follow up maybe twice, do you think it's to gauge that they are no more interested? Because sometimes it's just a long drawn out conversation before you always get to hear the final no. What have in your experience helped push these decisions to a more positive light? That's one. And then for founders who are starting out, most times the issue of having the thing here is like, oh, you're meant to provide all your documentation and information. But usually when you are starting out, it's not the case. You never really would have all this complete documentation, right? And it's a case whereby the current alternatives which you provided, not everyone is suitable for your business. As at the time you're starting out, you have good traction, but then you're trying to raise equity for your business to scale. And debt won't be the right time because you haven't built like a proper, will I say, cash flow documentation process. So in your experience, what has helped in pushing towards the needle, especially on some documentation you may not have, and usually to provide that, oh, you're one of the best people, most preferred to receive that investment? Just a bit of touching on those questions. Thank you.
Okay, so I believe that's open to any of the speakers. Thank you for that, Timmy Tope.
Yeah, I think I can take, just to be clear on the question on the investor side. So Timmy Tope, are you saying, or let me just put it like this. Can you just repeat your question for the investor side so I just don't answer you?
All right, thank you. So my question is, when you're going to fundraise, the typical, I mean, there are 2 issues. One, the first is to know which investors to reach out to. There are, like you said, a lot of different investors who are saying they are writing checks, but how do you really confirm that they are actually writing checks, right? Even when you speak to portfolio companies, again, you might speak to founders and they're like, oh yeah, they invested in us, but you don't really know if they actually have the dry powder to invest as at the time they are maybe promoting, and you don't just want to send your documentation. And then the second point is, when you do have conversations, it's usually a long drawn out process, right? You would speak to them, you would pitch to them, you provide your deck, they would review, they'll give you a time, they'll get back to you. And most times that draws out for months and months and months on end till you get to hear they are no longer doing this. And oftentimes you find out that, okay, they've gone with another player. So how do you, at this point of drawn out plays, beyond sending your report, how do you push the narrative that you are like the best person to receive their capital at that maybe decision stage? Or do you have good guidance on how to even find the best investors in terms of in your lead list to reach out to? Thank you.
All right. Okay. So for the first question, right, you know, the amazing thing about this is when I was in venture capital, I mean, I was on the buy side, right? Then I went to investment banking and I was on the sell side, and I saw a little bit of like some of the frustrations that you can get as a founder, right? So for instance, we were working on a company called Smart Prof from Egypt, raising $1 million. Now, personally, because the company is an edtech. Personally, anyone who knows me in the ecosystem knows I have issues with edtech, right? Not because of fundraising for edtech, but naturally just because I feel the bigger players have actually just saturated the market in such a way that it's going to be hard for anyone to actually really like get to venture scale in edtech. But what we realized is they are very, very minimal, not just in Africa, but even globally, funds that actually focus on investing in edtech. And we discovered this and realized, at least for the database that we created, because we did a database from scratch, I worked on it, 30% of the funds were dead. So there's something called dead funds, meaning they've probably expired on their, as 𝐂𝐚𝐥𝐿𝐴 mentioned, their dry funds, but more, it's just more of like their drawdown, right? So their drawdown has already reached the expiry date on their limited partner agreements, right? So they are not deploying anymore. Some do have follow-on capital alone, not for new early stage companies or new growth stage companies to invest in, right? So I'm going to tell you, to be honest, it's quite hard trying to figure out who is deploying or who is not deploying. The best bet that you can is like one of the growth stage companies that we worked with, they actively invested in tracking, venture capital funds, right? They subscribe to Playbook, right? Crunchbase, right? Using that filters to track who is funding, who has allocated capital in the last 12 months. So those kind of things can give you more of like a closer chance to actually knowing who's deploying. Another thing is joining mixers, speaking to people. I always say this to people, right? Always connect with analysts, right? I know everyone wants to have the ear of a decision maker, like maybe a principal, a senior associate, or a partner, but always connect with analysts. They're the ones who are likely to give you as much information as you want. They will talk. They're more likely to talk as opposed to a partner level person or a principal level person, right? So those are like some of the things that you can do in trying to know which fund is actually actively deployed. But like I said, in practice, it's quite hard, but at least these steps are some of like the things you can take, right? For the second question, in terms of a VC probably getting back to you, the truth is, I'm not going to apologize for like the venture capital ecosystem, but I'll say one thing, right? If you are going to be invested in a venture capital fund to reach out to you. So I always tell founders, do not worry about following up, right? Because I've not met anyone who has followed up and their following up got the interest of the fund to invest in them. See, let me run you through the process in the venture capital fund. If you, for instance, Temitope, come to me, I take a call, my analyst does the call memo. After the call, me and my analyst discuss, right? What's your initial thoughts on this company? It tells me, I take notes, the call memo is sent to the partner or the principal, right? The partner, maybe later that week, let's say we take the call on Monday, we're meeting on a Thursday, then every one of the interests that we have, then we talk about it, right? Oh, who should be put on pause to later look back to, right? Those people just immediately go into the something we call back then at the secondary pipeline, right? So those people are just stuck there in the sense that the people that were far much more interested in, because of limited resources and limited time, I can tell you that most venture capital funds are very small teams in Africa, right? So we're more focused on where we want to put most of our energy into, right? So if we speak with about 10 startups in a week, and we find interest in 5, interest being that, okay, there is something here. And let's say the partner and everybody agrees that 2 out of those 5 are the people we really want to have a second call with. The remaining 3 are just kept in the secondary pipeline based off of several factors. So one of them can be if the 2 eventually, either through negotiations or term sheets or whatever, we did not get to, an agreement, we look back at those other 3 and look at what we can do, right? So for example, I can give you a practical example. 2021, a situation happened where we had 5 startups. 1 was an LTech, the remaining 4 were fintechs, right? So the LTech obviously was going to get funded because they were direct competitor to Versita, if you probably know Versita, right? The name of the company was Clinido. The remaining 4, right? There was 1 particular one we later invested in. Then the remaining 3 that were left, we've kept in the pipeline. There are some popular startups. I don't want to mention names now because of history. Some of those startups right now in the media, but we went back to those startups based off of interest. So Clinido, we eventually invested in Clinido due to terms of negotiations, things fell flat. Went back to the secondary pipeline, brought out a particular startup and looked at things. Okay, this particular startup might not be as interesting as this, but what are the potential? Can we negotiate on price, right? So this, what I'm telling you, is basically what is happening. So we're not thinking of, giving you updates that, you've gotten to this stage, we're talking with this person. We don't do that because we're trying to figure out who are going to actually work on their memo and take to IC, right? So during all that process, if you're of interest, we will reach out. That's just how it is. I always tell people, if a VC is interested, they'll reach out to you. Do not bother about following up and all that. I would say, you're building your business. Why are you concerned about chasing a VC to hear what they have to say, right? The only periods where I can say you can start following up is when there's a second call, a third call, they're reviewing your data room. There's already conversations, right? Then there can be follow-ups. But after the first call, do not bother trying to follow up, right? Do not bother trying to check back on the VC. Like I said, if the VC is interested in you, he will reach out to you. That's just the truth. And for the part of where you say you want to get the VC to probably like come back, maybe what is driving that decision to say yes? I think that can't be controlled based on whatever it is that you have, right? If your traction is good enough and it fits their thesis, they'll reach out. It's just that simple. If your traction isn't as good enough, they'll likely not reach out. And if they do, obviously you get the unfortunately email, right, that they're passing on you and they'll like you to keep in touch. But that's just basically it. I hope my my monologue was enough to give some semblance of understanding.
Thank you.
All right.
Definitely, and thank you for sharing all of these. These are insights from years of experience. As we said, over the last couple of years and over the last decade, investors have really refined the thesis about this market, right? There've been lots and lots of learning, so it's always great to get a sense of the mind of where people are at and where investors are at. Okay, so I think we have one more input, and then we'll probably be closing out. I think David.
Yes, I'll just keep it short, right? It's just to buttress what Jimoh just said. So literally for VCs and investors, even for me, because I've been in two end, try to raise and invest in also. The highest time where I got a lot of requests to fund was when I was not even reaching out to the investors. That's the funny part, right? And the one when I was trying to raise, when I was going after them, right? the people that eventually invested in us, because I collected just 2 checks from 2 people, was mostly I just sent them the deck. We had the call and they were just there. I never even bothered. So I just kept doing my thing. I kept building, right? And I don't know, it was as though they just came and it was as if they did not give me the money today, there will be problems. And I was like, okay, what's changed? I tried asking them what changed. None of them told me what's happened, right? So I don't know. I don't know if it's it. I think you already explained the other part of it, the other technical parts behind the scene. But from experience, I just noticed that once you just talk to them, have the intro call, you've gotten the first level of relationship with them. All you just need to do is just be updating yourself either generally or you are sending them. Maybe you create so there's another thing we did. No, sorry, and that's I did for one of the companies that I invested in and we're trying to raise full on capital, which worked out very well. Was we created the way we have newsletter for customer. We have newsletter for a list of all the investors that we feel they are best fits. So monthly updates, we just one push. It goes to them, whether they respond, whether they like it, whether they read it. We just keep pushing every time. And from there, the following round was successful and we were able to even exit our first capital that we invested in as a syndicate. So yeah, thank you.
Thank you very much. Another really practical thing that you can easily do. So thank you. That has been part of the call. We really, really appreciate the time of our speakers and just the nuggets that have been shared today. Please, 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 these are really practical ways that this is your baby, right? And more than that, this is the value you can bring to the African continent. So we look forward to seeing successes in this. Just to say that the SME Success Playbook is ready, as well as the Funding Readiness Checklist, and that will be shared as well with the certificates to you. So once again, on behalf of 386 Consult, on our speakers, we want to say thank you, and have a successful and profitable one. Bye.
Hi, Sheye. I'm trying to end the recording. I'm trying to fix. Okay, I'm trying to end the recording. Okay, and then for the live stream. Okay, Sheye, thank you so much. Are you in a meeting?